He sent it to, Luke sent it to everybody?
Mm-hmm.
Oh, good.
I was using the 7th one, so.
You're using what?
I was using the 7th edition.
Yeah. Tim, do you have a sister?
Yep.
She skipped school the other day?
Did she watch school?
Skipped school the other day?
Yeah, I think she did.
I was supposed to be her sub, and I saw the name and I recognized it. Oh no, Dr. T? Oh, this isn't good. This is not a good sign. You're gonna sit in on this one? Oh, now the pressure is on. Now the pressure is on. Now you're here. I gotta be perfect.
No, you're fine, you're fine, you're fine. I like the tie.
Oh,
Is it because
yes,
of the
thank you.
camera?
What?
Is it because of the...
No, it's because I'm going out tonight and I didn't have enough time to like prepare to change. So, put the tie on at my last job. Now on the car ride back to my house, I'm gonna change my shoes and my belt. Then we'll be good to go. You got my email?
Yes,
Yeah.
it's not the end of the world. It's
No.
not the end of the game, okay?
Yeah, that's fine. Not a big deal.
I don't know. I was just talking to Megan right now, and to be honest, you're probably a better candidate than me when I got accepted there, so I don't know what to say.
Yeah,
And we tried.
yeah, I appreciate it, but
It's kind of stupid. That's what it is. I don't know. They have changed things there, apparently.
oh yeah.
Something with the process and this and that, but still, on the other side, you know how it is. Sometimes it's a game of numbers.
That's true, yeah.
Right. You're gonna get somewhere, okay?
Yeah, I'm not too worried about it. That's generally how I am about things. Like everything works out in the end anyway. But,
Yeah.
I've got like 7 more to hear from anyway, so
Yeah.
it'll all work out. I think we almost have everybody. I think this is the most on time everyone has been.
Yeah.
Oh.
I don't know. And you have more people than last year.
Way more, double.
It's so warm in here.
It is warm in here. I did not do that. I have no control.
Look, how are you?
I have Porto in my hair. Thought I was gonna have time to.
So everyone should have gotten the email. I shared this with all of you. I did make one minor edit. I did add a homework assignment at the end. It's just 2 questions. We'll go over them at the end because the way I put them into the PowerPoint doesn't seem like it would make sense, but in my mind it makes sense, so that's what's most important. But so what we're talking about today is chapter 4, what is money, or the monetary system, what it is and how it works. Have any of you taken money and banking yet?
Yes.
2 people. Alright, so this chapter is the most abridged version of money and banking that I can think of.
Okay.
I don't know, I think Dr. Nick's version of money and
Well, I don't know then, because I took it with Dr. Mihal the semester that Dr. Nick was on sabbatical. None of you were probably students at that point.
Well, I had Dr. Knight.
How long ago was that? Was that 3 years ago, 4 years ago at this point?
It's been a while.
Um,
I don't know.
It might have been before you were here.
Maybe before me.
Oh.
Because I remember Dr. Nick every semester.
Yeah, he went on sabbatical with Kepler.
With Kepler, yes.
Yes, in Greece.
Well, they wrote the paper.
Did they?
Yeah.
Well, we went on sabbatical for a purpose, but he wasn't here, so Dr. Mihal took over a lot of his classes, including money and banking. It was the only class that I got a B- in.
Well, it's the only class I got C in.
But like I said, most abridged version I can think of. So basically, what is money? We all use money all the time. So it's the stock of assets that can be readily used to make transactions. So in this, we get very specific about our definition. Cash on hand, demand deposits, money market accounts, things like that. But we can't say that it's all assets, because not all assets are readily available to make transactions. It also has to have cover these three different purposes. So it has to have a store of value, a unit of account, and it has to be a medium of exchange. So with store of value, we haven't talked about inflation yet, but I know you've all covered inflation in classes. So because of inflation, a dollar today is not the same as what a dollar is going to buy you in 10 years. So I can go into the dollar store today and buy a bag of chips, but if I go into the dollar store in 10 years and buy a bag of chips, that bag of chips is going to be considerably smaller. That's just the way it works. A unit of account, so basically everyone can keep track of what they owe or what's due to them in this unit, and also a medium of exchange. So everyone accepts it because there's some sort of value to it. It doesn't have to be an intrinsic value. It doesn't have to, like gold has a value, we give it a value. Fiat money, which we're going to talk about, which you've all talked about, there's nothing backing it besides our trust in the government saying it's, yeah.
Where do cryptocurrencies fall?
In what capacity? What do you mean?
Do they count as like money?
Not according to IRS.
Oh, well, because are they widely accepted?
It's legal in a couple of countries, but like otherwise,
What was that?
it's illegal here and there. But like
It's what?
It's illegal here and there, but it's kind of accepted.
Yes.
By everybody?
Think about, do you
Can
want
you?
your
Can I
salary?
keep track of what you owe me in Bitcoin?
Could, but it changes.
I could, but would I? Do people willingly
You
trade
can pay for
Bitcoin?
some stuff in Bitcoin.
Would you
Some,
like,
but
would you like your salary to be paid in bitcoins?
If it's worth a lot.
but is it always worth a lot? Does it have a stable value?
No.
See here, the store of value. It's not perfect, but in the same vein, you can expect to be able to use that to purchase a similar amount in
So
the near
value
future.
is somewhat constant then.
Yeah, I mean with Bitcoin, today I think the price is probably somewhere. Is it still around 6,000 or 6,500? 3.5, is it?
It was 18,000.
Yeah, it was 18,000 at one point. At one point, you could get it for like a nickel. So like, the value there is wildly fluctuating. So if you were going to assume that the value of Bitcoin was going to go way up, of course you would take payment in Bitcoin because all of a sudden your asset, well, not your assets, but if you can resell it, you're going to have a lot more cash on hand. But you'd have to resell it to have the cash because that's what almost all of our transactions occur in.
And guys, you have to realize that there are other assets in the economy which are as risky as Bitcoin that can give you these returns. Why do you have to put your minimum exchange into that? You can go into real estate, you can go into penny stocks that are going to work pretty much as a Bitcoin. Do you want to be paid in that? No, you can be paid in something else. And if you want to and make a decision to be as risky, you can go and buy them.
And I mean, the other issue with that is saying cryptocurrency is there are not almost anyone, but someone with an advanced computer science degree can create a cryptocurrency. I have a friend that insists that cryptocurrency is the way of the future, but if you ask him which one, he couldn't tell you. So what good is it? You know, if you can constantly just change your currency like that. But what's key here, this is all of these three purposes let us get rid of this double coincidence of wants. For a second, I didn't think that was a real word. Because if I want a bag of potato chips, and you have a bag of potato chips, and let's say I will trade you a cat for a bag of potato chips. What if you don't want a cat? Can I get those potato chips?
Probably not.
Yeah, so, but with money, we can use that, because then you could say, well, I don't want a cat, but I'll take the money and I'll buy whatever it is that I want. So it allows for these indirect transactions. If you read the textbook, it goes into this lengthy example of a college professor who then purchases books, and then he gives the money to the publisher. The publisher trades the money for paper. The paper company trades the money for lumber. The lumber company trades the money to a lumberjack. And the lumberjack uses the money to pay college, and then the college pays the salary of the professor. So it's all these indirect transactions just to get what you want. But that's what money allows us to do, and that's why it's important.
We still do have double coincidence of wants for certain things in the economy.
That's true,
That's
especially people who want to avoid taxes to some extent.
No, yes, that, but if you think about anything which is interpersonal relationship, right, it's usually double coincidence of want, otherwise it's called crime. Or assault or whatever you call it.
Well, I'm thinking like if I'm my brother's a mechanic, so my brother will trade his services as a mechanic to an electrician.
Right.
Because they both need work done. They don't want to exchange cash because it's more expensive for them to pay each other than it is to just do the work for
Oh,
each
yeah,
other.
yeah. People still do that.
Yeah, and it winds up saving each of them a considerable amount of money, not just in expenses, but then also in taxes. But the government doesn't want us doing that. You're supposed to claim that income somehow.
Okay, guys, enjoy. That is fun, but I go.
Oh, Eugene, what does that tattoo say?
You're doing great. All of you are doing great. You're doing great. That's not even the weirdest one.
Yeah, well,
I have two more. I've got one over here, it's a sun symbol. And then I've got one on my calf that is an avocado.
Nice.
I got it on April
Why?
Fool's Day.
Oh.
My mom really hoped it was a prank, and it wasn't. When it gets warmer out, I'll probably wear a short. I know I told some of you that I would never dress up for this class. I'm not getting dressed up for this class. I'm getting dressed up because I've worked before, and then I'm going out later. So like, I'm not gonna change just to show up to this class in a sweatshirt and jeans. But when I wear shorts down the road, if I don't have to work ever, which I'm really hoping for, you'll get to see that. All right, so we've got different types of money. So first we got fiat money. That's what we use nowadays. It has no intrinsic value. We all use the American dollar, the US dollar, because we believe that we will always be able to exchange it for goods and services. We believe that people will accept it, and we believe it has some sort of value in that we can purchase things with it. It has a store value, it is a medium of exchange, and it is a unit of account. Then we have commodity money. So this is when we use a commodity. The example in the book is if we go and we just trade gold, right? So if I walk around with a bag of gold, I could weigh it out and give you gold per bag of potato chips, but we all have to agree that the gold is pure gold. We have to agree that the scale that we're using is correct. There's a lot of difficult things about it. This is what we used to do thousands of years ago, even hundreds of years ago. It wasn't until probably about we've had paper money for a while, but we used to essentially just trade coins that were made from gold or silver, some combination of the two. So that would be commodity money. And then we have the gold standard. So gold standard is we use paper money, but we say you can exchange this paper money for gold if you want. We got off the gold standard officially, I think, in 1972. Everyone thought the world was going to end. It didn't. We're still going strong, mostly. You know, the environment's on its way out, but whatever. It'll all be fine. But so that's pretty much gold standard. And then for the two, you both took it with Dr. Nick.
Mm-hmm.
So Dr. Mihal goes in depth about these different types of money. She gives a case study already on the POW camp, on what's some other island? The island of Yap. But so essentially in these POW camps, the story goes, they're all trapped, they're prisoners of war. They don't have money to exchange goods and services. The Red Cross sends them packages of things, so they've got clothes, food, cigarettes, whatever it is. If we think back to the 1940s, everyone smoked. If you didn't smoke, you definitely were not cool. But what they found in these camps is that people would take the cigarettes and they would exchange them for goods and services. So people who wanted to, of course, there are a lot of problems here. What are some of the issues with using cigarettes as a form of currency?
You're not regulated, you can't make, well, you can make them also, but also it's like they ship in like a big case of them, it kind of changes the influx of how much is in the system. It's not really stable.
Okay, so we have a different amount that's in the system at any given point. What else?
They're consumed.
They're consumed. People will smoke them, which changes how much are in the system. And there are a couple of other issues. Those are like the big two ones. People will smoke them, and the amount in the system always changes because of that. The other issue is, can you have a cigarette and keep it in good condition for 6 months. For 6 days if you don't have a pack, a proper pack. No, so they wear out essentially very quickly. So their store value isn't great. But they were medium in exchange, and they were a unit of account. Again, that unit of account gets shaky because the amount is constantly changing, so the price of things would the quoted price of things would constantly change. But again, using these cigarettes as a form of currency worked in this situation. It wouldn't work today because, again, I think like only 7% of the population still smoke cigarettes, so I don't think that would work if that's what we were using as currency. But so anyway, the development of fiat money. So commodity money, again, was the first thing we used. That's what I was just saying. It's this raw gold example. So you can walk around with gold, weigh it out, and exchange it for goods and services. But like I said, you have to test it for purity. You have to assume that the weight is the same. I think it was in like the 1700s. That's when they first really started standardizing weights, because people wouldn't trust the value of coins, especially well in France, because the French was, they were going through that revolution where they beheaded a bunch of people. But so people weren't trusting the coins anymore, so they needed a standard weight system so that they could weigh out the coins to make sure everything was proper, I guess would be the term. But so after the gold coins, the government would accept the gold coins in exchange for dollars. So this would be the gold-backed currency, gold certificates they're called. Again, because they were lighter and easier for transactions. I mean, a dollar, you can still have a dollar in your pocket from the 1970s. It won't be in great condition, but it could still be in circulation, theoretically. What's really cool is if you get dollars that are old enough, they'll still say gold certificate on them, or you'll get silver certificate dollars. But that's the system we were on for a while, and then eventually we kind of just got rid of the gold standard because no one was exchanging their dollars for gold anyway, so it didn't matter. I don't think we really talk about it in this chapter, but one thing we do keep in mind nowadays is the United States dollar is the world reserve currency. Every currency, like a lot of things are transacted in the US dollar. So like the oil market all takes place on the US dollar. So I'm not gonna make that comparison, but because it's chapter 6 really, but a lot of governments are concerned with their value relative to the US dollar because of how many things are traded on the US dollar consistently. Oh, and then this was another case study in the chapter, money and social conventions on the island of Yap. So their currency were these 12-foot diameter stone wheels. We can't really move those easily because, stone is very heavy, especially when it's in a 12-foot diameter. So the exchange of currency was difficult, so all people would know is, oh, I own that stone on so-and-so's property. People would just kind of assume it to be true. What's pretty interesting in the chapter is they even talk about how, like one of these stones was lost in the ocean. I guess they were traveling with it. The boat broke or whatever, it fell into the ocean. But everyone assumed that the stone was still there. So someone still had claim on this dollar, and they would just constantly exchange it back and forth for purchases. All right, so moving on. Are there any questions so far? No, it's all pretty clear. How the quantity of money is controlled. So we have the money supply, so this is the quantity of money in the economy. So in a commodity money system, the money supply, is the amount of the commodity. So if we have 100,000 tons of gold, that's how much money there is. That's just what it is, it's in the system, nothing can change. In a fiat system, the government kind of just controls this money supply. Through legal restrictions, of course, that give the government the sole right to print money. They can say, we're going to print this much dollars this year, and so on and so forth. So monetary policy, that's the government control over the money supply. And when I say government, I mean the Federal Reserve or the central bank. Fiscal policy is when we talk about how the government is spending money. Monetary policy is central bank policy. So the central bank, it's a partially independent institution that has control over monetary policy. So here we use the central bank, which is called the Federal Reserve. Two of you, right, are from Europe, so you use the central bank.
I think,
Three of you.
us. Yeah.
You're from Ireland?
England.
Alright, so you guys use the Bank of England,
Mhm.
but we all have a central bank, essentially. Which, again, the whole goal is that it's partially independent. This is actually what a lot of Dr. Mihall's research is on, is the independence of central banks from their governments. I found her thesis paper one time. I didn't read it because it was way too long and very complicated, but it talks about how when central banks aren't independent, there's a lot of corruption that could go on. So in the United States, monetary policy decisions are made by the Federal Open Market Committee. During the Fed Challenge, this is essentially what you guys are pretending to be. So it's made up Federal Reserve Board, so appointed by the President of the United States, not of the bank, and they're approved by Congress. They meet every 6 weeks to make decisions. Are they going to keep interest rates the same? Are they going to increase the supply of money, decrease the supply of money? Are they going to lower the interest rate? Are they going to increase the interest rate?
You could appoint someone new recently.
What was that?
Did they appoint someone new recently?
Yes. It was Janet Yellen for a while.
Jerome Powell?
Huh?
Is that right? Jerome
Yeah.
Powell?
That's it. Jordan Powell. I went to high school with a guy named Jordan Powell. Different guy, definitely, but
Yeah. They just announced today that they just got like inflation data and it's like 2.2% above what they're hoping for.
2.2% above what they're hoping for?
0.2%. So the target was 2%.
Oh, okay.
That was 2.2, so they're looking at increasing rates.
Makes sense, all right. So usually they give a range, a target range, like they won't just say 2%, because it's hard to get 2%.
No, yeah, between that, I think they were aiming for like 1.6 to 2 point something, and 2.2 is on the higher end, so then,
Gotcha.
yeah.
So through these open market operations, they use the purchase and the sale of government bonds to control the money supply. So if we want to increase the money supply, we, the Fed purchases government bonds from the public. Does everyone follow? I know that sentence doesn't seem very complicated.
We said to increase.
The money supply.
Okay.
The Federal Reserve purchases government bonds from the public. Now, why does that increase the money supply?
Because they're trading in the, well, if you're increasing with, bond sponsors, like, yeah, so people are trading in their money to get the bond. But then when it matures in like however many years, doesn't that just put money back into the system?
But the Federal Reserve is purchasing the bonds.
Okay,
The Federal Reserve is increasing the money supply.
yes,
So they are purchasing bonds.
okay.
The Federal Reserve. Now, how does that increase the money supply?
Oh, they're getting money for bonds.
Yes, they exchange money to the public for bonds. So they send more money out into the economy. They don't give it for free, they purchase these bonds. So if they want to decrease the money supply, they sell government bonds. And people buy them because everyone wants a government bond because it's the safest investment you can make.
When those mature, people take the money out of them, so doesn't that put money back into the system at that point?
But if the Fed owns the bonds, then they just get the money from the government.
But doesn't that put more money into the system?
No, then then the Federal Reserve just has the money. They don't have to necessarily spend it.
Okay.
But I got you, like, yes, the bonds will eventually mature, but then the bank just trades them in and they get the money. And then they could go and buy more bonds if they wanted. They could constantly just keep reducing the money supply. It's not like they would do that, but they could. So how do we measure the quantity of money? So in a simple economy, the quantity of money is the number of currency in circulation. Makes sense? But we don't have a simple economy. So in a more complex economy, we also have to take into account demand deposits, so anything that's sitting in our checking accounts. I said demand deposits. Savings account and money markets accounts also apply to the money supply. Yeah. Because again, we can generally write checks against money market accounts. Savings accounts are easily accessible. So M1 is the currency plus demand deposits, traveler checks, and other checkable deposits. And M2 is M1, so it's all of this stuff, plus retail, money market, mutual funds, saving deposits, and small time deposits. All right. So the role of banks in the monetary system. So the original assumption assumes that only the Fed influences money supply. But the Fed is not the only bank that we have. We also have to look at how households will influence the money supply. So this stuff is basically covered in macro 1. Because we talk about reserve requirements, we talk about money multipliers, things like that. It's just, again, kind of a refresher in that aspect. But so the money supply equals the currency plus demand deposits. So C is currency, D is demand deposits. So what we can look at is how the banking system and federal policies affect money supply. So if we have 100% reserve banking, this is like a gimme question, I think. What percentage of savings do banks have to hold in their bank? If it's 100% reserve.
All of it.
Yeah, all of it. If I save $1,000 and I put it in the bank can do nothing with that. They have to hold on to it. So if we have $1,000, that's an inconvenient place for this to break apart. But that means banks can't make loans. They can't take that money and loan it out to somebody else. They have to hold on to it. So the only purpose of this bank would be to put your money somewhere safe where you know nothing's going to happen to it. Because if you stuff it under your mattress, your house could burn down and the money goes away. But if it's in the bank, it's safe. So essentially, the bank would have $1,000 in assets, which is the reserves, but they would also have $1,000 in liabilities because they owe you that money. You deposited it there. So if we have that 100%, the banks have no effect whatsoever on our money supply. But what we use is fractional reserve banking. So here we're going to assume that banks can make loans because they don't have to hold on to everything. But the bank does have to hold on to some of the money because if they don't hold on to some of the money and you go to get your money, then there's going to be a problem because then they have no money to give you. So in a fractional reserve banking system, the banks are allowed to make loans. They only have to keep a portion in the bank at all times. So
Zero on minimum, so we have to keep a minimum of 20% in reserves.
in this situation, we're saying it's 20%. I think in the United States we use like 10% or something thereabout. But we've all seen this terrible, terrible T-chart. Assets, liabilities. Because we all had to take accounting 1 and 2. You didn't. You're a history major. I just found out.
Yeah.
I was very disappointed.
Oh.
Okay. Mostly. But so here, the bank has a bunch of assets, right? They have these reserves. They have $200 in reserves. So those are reserves. But since they only have to keep 20%, the other $800, they can loan it out. So in loans, we have $800. But in a T-chart, we know the left side and the right side have to balance out. So our liabilities is this $1,000 that someone went and saved. So that's deposits. So this is going to be bank 1. First bank. Then we have our second bank. So I saved that first $1,000, and then one of you went and borrowed $800 from bank 1, and you took it and you deposited it into bank two. So again, we have assets and liabilities. Liabilities, I think that's how it's spelled. So there's, again, $800 in deposits in the second bank. And we only have to keep 20% of that in reserves, so that'll be 160. So then the remainder, the bank is going to go lend out. So that's what, 640?
Yeah.
So this essentially will go on forever and ever and ever and ever and ever. But eventually, you know, we take the limit of this function as it goes towards infinity, and we have an amount that's created in the economy. What we find is it's 1 over the reserve ratio. That is the important little equation that we have there. So if we have $1,000 in our system, and the reserve ratio is 20%, this 1 over 0.2 is going to give us 5. So that's how much we can take our money, the amount, the $1,000, and multiply it by 5. That's what we have in our system, $5,000. Does that make sense? All right. Oh, I have it right there. So the amount of money created in the system for each dollar is 1 over the reserve ratio, so 1 over RR. And then financial intermediation. So this is the process of transferring funds from savers to borrowers. That's what banks are doing here. Most common are stock market, bond market, and the banking system. That's how we do this transfer, from savings to borrowers. And banks are the only financial institution that can affect the money supply. You can't buy stocks on a margin anymore because of this, essentially. All right. So bank capital, leverage, and capital requirements. So bank capital, it's the financial resources used to start a bank, so that's owner's capital. So for our assets, we have the reserve of $200. The loan that
Why are you so dressed up?
I was working today. You're really late.
Oh, really?
Yeah.
Not in this class.
You are.
No, not. Well, not in the.
Not technically.
I'm going to take the same thing twice.
So we have the reserve, which was $200. That's what they have to hold on to. They loan out $500, and then they own some sort of securities for $300. So they could own bonds or whatever it is. Then for liabilities, they have $750 in deposits, $200 in debt, so that's what they borrowed, and they have capital of $50. How did I come up with this scenario? Oh, it's in the book. The scenario. But so liabilities can be used to issue loans, buy government bonds, or be kept in reserve. So this is the money that other people gave them. Leverage essentially is the use of borrowed money to supplement existing funds for the purpose of investment. So how much essentially do they owe out compared to what they have? So the leverage ratio is the total assets over the owner's equity. So that, in this situation, I abbreviated it to capital. So here, we would have $1,000, isn't it? Yeah, $1,000 in assets. Owner's equity is 50. So our leverage here is 20 times. So when the ratio is too low, it could lead to bank runs. Capital requirement is the restriction to make sure banks hold enough capital to pay off their depositors first, essentially. That's kind of how it works. You want to make sure the people that gave you money, you get their money back. So how does the central bank influence the money supply? All right. So in this model, we have the monetary base, which we abbreviate to B. So it's the total number of dollars held by the public as currency. currency, we already said, that's C. And the banks as reserves. So how much is in circulation plus how much do the banks have? So let's get rid of this. So we have, our original equation was M equals C plus D. Money supply equals currency plus demand deposits. We also have the monetary base equals currency plus, we're using R now, reserves, R. And this R is directly controlled by the Federal Reserve, how much the banks have to hold on to. So the reserve deposit ratio is just a fraction of deposits that the bank holds in reserves, and it's determined by the business policy of the banks and the laws regulating the bank. So banks can decide to hold on to more than that. They don't have to hold on to 20%, they could hold on to 23% if they want to. But there is always a minimum that they have to hold on to. Then we have the currency deposit ratio, so it's the amount of currency people hold on to as a fraction of their holding of demand deposits. So it reflects the wishes of households to hold currency to demand deposits. This situation, while it has, we can still use the same definition here. It has changed considerably because everyone kind of just travels around with debit cards now. So I don't have to hold cash to make purchases anymore. I can walk around with my debit card and make purchases just as easily. But if the money was held in my account before, so before debit cards, you had to have money in your account and you could have cash on hand to make purchases. Now you have your debit card and you can just make purchases anytime. You've combined everything into one, essentially. Everything could just be held in your accounts. And then again, we have this money supply equation. So money supply equals currency plus demand deposits. And then I even wrote it out in words in case anyone forgot. So it's the sum of currency and demand deposits. So for monetary base, it's the sum of currency and reserves. Currency, reserves. So note, we say C over D is the currency deposit ratio, so currency over deposits. And then R over D is the reserve deposit ratio, so reserves over deposits. See course notes. How did I miss that earlier? Ah, I see. All right. This is where it gets really annoying, and we have to do a lot of algebra. Don't forget those equations, they're still important. Bless you. So, to solve for the money supply, as a function of our three exogenous variables, which is the monetary base, the reserve requirement, and CR, which we said is, what do we call it? Currency ratio? Currency deposit ratio. This is what we do. We take our original equation, so M equals C plus D, and we divide it by our new equation, B equals, keep the equal sign, C plus R, capital R. So, we can divide everything on this right side by D, because that's just assuming we're dividing everything by 1 essentially. So we get M over B equals C over D plus 1 over C over D plus R over D. Everyone following so far? You're staring at it, are you
But what
good?
about the other side?
We don't have to do that, this is just 1 over 1.
Oh, okay.
You can change anything by 1 over 1. It doesn't matter. D over D is the same thing as 1 over
Oh,
1.
yeah,
1 over D is the same. 1 over D over 1 over D is still just 1. which my
Why is it a student's
calc
fault?
students yesterday had a terrible time understanding. What was that?
Why is it a student's fault?
So 1 over d, the word we used when we went to school was cancel out. We don't use cancel out anymore, now we say simplify or something stupid. 1 over d over 1 over d, they can just go away, and it's 1 over 1, so that's just 1. So it's the same thing that we're doing here, we're multiplying everything on this side by 1 over d over 1 over d, essentially, to get this. Well, this really belongs up here. But what's nice here is c over d is the same thing as cr. So I'm going to rewrite this again. M over v equals cr plus 1 over cr plus rr. And we can get rid of b here and put b here and say we're multiplying. So now we're just going to use parentheses because we're adults. We don't need the x.
Why is it CR?
Currency over deposits?
Oh, that's.
Yeah. We're just substituting in the language we've established there. All right. Now I've got one more thing to substitute in here. This, right here, we can call it the money multiplier, which we've all worked with before. And we're just going to call it lowercase m. So, our money supply equals the money multiplier times the monetary base.
What was the M?
Which m? This m?
Yeah.
This m, lowercase m, equals money multiplier. So what portion of our income do we save versus what portion do we spend?
Say 20%, spend 80 or
Well, it could be anything in any scenario. United States, we really don't save that much, so I don't know. It's kind of ridiculous. But so anyway, if we suppose our monetary base is 800 billion, so I'm gonna work on this over here. So I'll just say 800. I'm not gonna write all those other zeros. The reserve deposits is 0.1, so 0.1. Our currency deposits, or currency deposit ratio is 0.8. So we just substitute those numbers in. We get money supply equals, so this on top is 1.8 over 0.9. Should all be able to do that. Just 1.8, so just 18 divided by 9, right? Times 800. So we get 2 times this 800. So our money supply here is $1.6 trillion.
how does that translate to trillions?
Because this was 800 billion originally.
Got it.
From this little scenario. So the lower the reserve deposit ratio, the more loans banks will make. So this was where we put the currency, the reserve ratio.
Just a quick question for the one with the numbers. So if we got
Here,
yeah. So if we got D is equaling
D.
1, like because I just want to know, like, fit in my head. So that's like this M here. So we're inputting the numbers.
Yeah,
Oh, so
we
it's
just took this,
one.
so we took this equation,
Yeah.
derived this, and
Yeah.
from here,
Okay. Yeah.
we just did this math.
That makes sense. Oh, thank you.
So the lower the reserve deposit ratio is, the more loans banks make. That makes sense. They don't have to hold on to as much. They'll just loan it out and make more money. And then the lower the currency deposit ratio, the fewer dollars in the monetary base held in banks as demand deposits. So the fewer loans that can be made. So people are holding more cash than they are deposits. Does that make sense? All right. So, what can the Fed do for monetary policy? How the Fed changes the monetary base. So we already talked about open market operations. They can buy or sell bonds. Banks can also borrow from the Fed, but we all know we don't want to deal with a bank that's borrowing from the Fed. That means no one else will loan them money, because no one wants to go to the Fed to borrow money. It's like in 10 years from now. Let's say you all have your careers, whatever, and then you all get laid off, and you have no savings. How many of you are going to want to go to your mom and dad and be like, hey, I need money? No one wants to do that. At 31, you'll all be, essentially. So, it's the same idea here. We also have the discount window. So this is the way that banks would borrow money from the Fed. So the discount rate is the rate that the Fed charges on reserve loans. So if the bank doesn't have enough money in their account, essentially they'll go to the Federal Reserve and say, hey, I need to borrow money to make up the difference. So the lower the discount rate, the more reserves are borrowed by banks. That just makes sense. It's cheaper for them to borrow money, so they're going to borrow it. And then term auction facilities. So the Fed determines the amount that it wants to lend, and an eligible bank places a bid to determine the interest rate. So it's kind of that supply and demand idea where, like, this is how much they want to offer, what someone willing to pay for it. So the Fed can also change the reserve deposit ratio, so they can change the reserve requirements. The Fed regulation that imposes minimum reserve deposit ratio on banks can always be changed. So by raising the RR, it lowers the money supply and lowers the money multiplier. Because banks have to hold on to that money, they can't loan it out as much. Excess reserves, so reserves above the minimum requirement. And then we also talk about interest on reserves. I don't know if the Fed actually adopted this. Do you remember if they actually adopted interest on reserves?
Some reserves, yeah, they have some reserves.
All right, so that's a recent thing, like maybe within the last 3 years. The Fed will essentially pay you money to hold on to money, so you're not losing money by not doing anything with it. This is for banks. This is not for the public. The public cannot do this, but banks can do this. So the higher the interest rate on reserves, the more reserves will be held by banks. That just makes sense. They can get a very safe, it's not a good return, but they'll get a safe return with the Federal Reserve. So some problems. Can the Fed perfectly control every action of every bank that exists in the United States? No. And then we also have bank failures and the money supply in the 1930s. This is a case study in the textbook. I'm not requiring you guys to read it, but essentially we found that the money supply fell by 28%, which is a big deal. All right, so we're at our conclusion. What time is it?
4:51.
All right. Maybe we'll have to talk slower next time. But so anyway, so money is the stock of assets used for transactions. So we talk about commodity money and fiat money. Again, what kind of currency do we use nowadays? Yeah. We have a fractional reserve system, which creates more money because banks can go and lend the money out. They don't have to hold on to it. And the supply of money depends on the monetary base, the reserve deposit ratio, and currency deposit ratio. The Fed influences the money supply by changing the monetary base or by changing the reserve ratio. Those are the two ways they can affect things. So it can change the monetary base through open market operations by making loans to banks. So they could either buy these bonds from the public, sell bonds to the public, or they can make loans to banks. And then they influence the reserve ratio by altering reserve requirements. So they just tell every bank, like, hey, this is the new number you have to go with. Or by changing the interest rate it pays to banks for reserves that they hold. Make sense? All right. So, assignment. It's your first assignment of the semester. Oh God. Yeah. All right. There's only 2 questions. First question has 3 parts. Second question has 3 parts. I did not pick problems that really had a lot of math. It's mostly just explaining, because when you do the Fed challenge, you don't have to do math. You have to explain things. So this C here, that goes to 7. I didn't want to take another picture of the textbook and upload another picture, because I didn't realize until after I added this slide that there was a part C to the question, and I didn't feel like leaving part C out. So, oh, actually you do have to read that case study that I told you I wasn't going to require you to read. So anyway, the case study about the Great Depression. It's on page 99. I know you sent the textbook to everyone, right? Yeah. So the case study is in the textbook. Answer these 3 questions. You can type it up. I mean, it doesn't have to be anything too lengthy, just however much you need to answer the question. Same thing for 7. 7 is definitely much more of an analysis question than 6. So it's 6, you have to use money supply, so essentially this kind of stuff to answer it, and your own intuition. And 7 is just really talking about this tax, this 2-cent tax on checks. You know, if it winds up being a page, that's probably good, which for 6 parts isn't a lot. But I mean,
Sending it to you.
you can email it, you can hand it in next week, I don't really care, pretty easy. But I do want it. I'm gonna keep track, I'll read them, see how you guys are doing with it. That's kind of it. Alright. Don't forget to remove yourself from the computers,
Why is that like your biggest pet peeve? Every time I see that.
because I don't want 20 names every time I go to log in.
Can I borrow your textbook for 2 seconds?
Yeah.
Can you do it? Still looking online, so I'm not looking around.
We might get to a point where I show you a PowerPoint I made on all the dogs that I know.
That's the last one.
No, I made a new one for my middle schoolers. It's 26 slides. Each slide is a different dog, and I'm missing about 6 of them.
Whose dogs are these?
Dogs I dog sit, dogs I'm friends with, my brother's dog.
My old friends. Eugene, do you know why capacity utilization was so high in the 70s?
No.
Okay, needed for Meg, but I don't know how to find it.
Saying that it's been fun, but it's been online, but I'll have to get kicked off the course.
I need to add you in the group.
Oh, there's a group?
Yeah.
Okay.
See you next week.
See you next week.
Let's look at
Yeah.
chapter 5 and 2.
What?
Look at chapter 5 then. so-
Oh yeah, that'd be a good idea. Chapter 5 next week, guys. Bye. Yeah.
See you later.
See ya. Tell your sister not to skip school. Not good
Yeah,
for her.
I think she went prom dress shopping. You know how it is senior year.
Have a good one.
Yeah, I never went to school. Especially second semester.
Exactly. Wait, what class was it for actually?
It was either pre-calculus or RCC calculus.
Oh, for
Kavanaugh.
yeah.
Yeah.
Okay. I had her too. She's actually a pretty good teacher.
That's not what everyone else was saying.
But really? I actually like her.
I like her, she's nice. But
Yeah, I mean, I didn't really do anything second semester. I mean, second half of the year either. I don't know. I didn't think she was that bad.
They don't even have capacity utilization in here.
that's probably because no one cares about it. Are you applying to grad school?
That's great. You know what? Mihal said the same thing to me today. I don't wanna think about it. I gotta figure out actuarial stuff first. You people are driving me insane. Ugh, I don't
That's
know.
fine.
Sucks. I was like freaking out in her office, and she's like, you know what? Just try to relax, but have the paper ready for tonight. And I'm like,
Wow, on Valentine's Day, that's harsh.
great. I know.
You guys going out?
Alex wants to go to Cheesecake Factory, but I feel
What?
like that's gonna be a madhouse. So like,
Amateurs.
well, I brought him there for the first time like a month ago, and now it's like his like, new obsession. He's like, let's go back. I'm like, who's never been to Cheesecake Factory before?
I only go for their bread.
Yeah, the bread is good. But I mean, he acts like he's like a food connoisseur because he worked at a kitchen.
He works in a kitchen?
He used to.
What kitchen?
He used to work at Raph's Pizza in Pearl River. I don't know. He says it's like the pizza place, and then he was the main like cook at then Pearl River Taco and Burrito.
That's not a place.
I know. So he acts like he's like